Hello, welcome back, guys. Miss Fierce here from the Fierce Trade House. Welcome to my YouTube channel, guys. We've been talking about Forex in terms of the from a beginner's perspective. So this is our module 3. If you haven't yet watched module 1 and 2, please first go there and watch module 1 and 2, where we begin to introduce the topic of Forex and what is Forex and the terminologies that we use in Forex. Now, in this specific module, we're going to be speaking about brokers. Okay, now before I say anything else, let me put a disclaimer. I am not a financial advisor. I am not a financial consultant. I am just a trader, and I trade for a living, and I am here just sharing my information or my knowledge with the community, adding value to the space. Okay, that being said, if you need financial advice, please seek a financial consultant. Okay, now, so brokers. So what is a broker? Okay, a broker is basically the entity that you're going to use to facilitate your trading. Okay, so if you want to now actively begin to trade, you want to place your buy and sell orders, you want to start buying currencies and so on and so forth, you need a broker. Okay, so they are the ones who execute your orders in the market. And basically, by an order, I just mean an instruction to buy or sell a quantity of a product. So in this scenario, we're talking about a Forex broker. If you are in the stock market or the cryptocurrency market, you'd be speaking about Forex, crypto and maybe stock brokers. Okay. Now, when you're thinking about choosing a broker, you need to think of a couple of things or keep in mind a couple of things. That these brokers are regulated. Ensure that the broker you choose to use for your trading is regulated. Regulated meaning they have a license to operate as a broker in whichever jurisdiction you're in. Some brokers have local jurisdiction or licenses. Others have regional, continental, I suppose. So there are different brokers depending on where you are in the world. If you're in Kenya, most brokers are licensed under the CMA or the Capital Markets Authority. And if you are, let's say, in East Africa, you just figure out which brokers work where. But then we do have international brokers even here locally that you can use. And I'll drop a link to just share with you the brokers that I use. Some of them are locally licensed. Others are actually in the, licensed under SISEC. We have FCA licensing. We have brokers that specifically are licensed in America. So if you're in the US, you can only. I mean, if you're not in the US, you cannot use those brokers, and so on and so forth. So anyway, that aside, make sure they're regulated. Make sure they're transparent in terms of you actually know, what. I mean, are they really a broker like you? They kind of have history as well. They've been around for a while. And it helps again if they're locally licensed. So that means they probably have an office in your area. Just do your research. In other words, okay, and make sure that their interests align with yours. And I'll explain to you as I give you the differences between the types of brokers that are there. Then it's nice if they have low fees because you're trading and you want to make money, so you don't want all your cash going to a broker in terms of fees. But then again, that is relative depending on the kind of trading you'll be doing. And then leverage. Do they have good leverage? We spoke about leverage in the previous module. You understand what leverage is. How much leverage are they giving you? Some brokers will give you, like, for every dollar, they'll match it with $100, so 1 to 100 leverage. Others will give you 1 to 50. Others will give you 1 to 30, 1 to 10. Others will give you a maximum of even 1 to 500, 1 to 1,000. So it's really going to be up to you. Remember what I said in the previous module as well, that leverage is a double-edged sword. So you need to be very cautious about how you play around with it and what kind of leverage you're going to choose to trade with. I usually recommend just trade with a leverage of 1:100. You don't need more, but you may be tempted to actually take a bigger leverage, 1:400, that's fine, but please understand the risks. Then make sure that they have a good platform, again, some of these things also come with experience, but also I can also recommend what I use. But good platform just means that it's easy to use, they're available, it's not freezing up and things like that, And then more importantly, that they have support, that you can actually talk to somebody when you have a problem with your account, because it may happen that maybe something happens with your account, or maybe you're having challenges with withdrawal and things like that. Yes, and on withdrawal, it also helps if you can easily withdraw your cash And for myself, where I am, like I like to withdraw and make deposits through, for example, our local mobile provider, which is Safaricom M-Pesa. And so it's just really up to your preference. And yeah, so support is really good. That being said, what are the types of brokers that are generally there? We have three types. We have, first of all, the A book and the B book brokers. So the A book brokers, or what you call the ECN or STP brokers. Okay, you may see something like that when you see a broker. They may tell you they're ECN and STP, and you may just wonder what that means. It's just that STP, it just means that they process their orders directly through their liquidity partners. Now, what you need to understand about brokers is they have liquidity partners, okay, generally, who now provide for them the liquidity to be able to allow you or give you the ability to execute your orders with ease, as fast as possible, and so on. So EC and STP brokers are really pretty good because they have those huge liquidity partners behind them, and so that they're secure. And then the good thing about them is, because you're getting orders directly from the liquidity partners, I mean pricing from the liquidity partners, or orders executed directly, it means that you're also going to be getting good rates in terms of, if you're buying a currency, you're going to get it at a good rate or fee. And the way these brokers make money is just basically by increasing the spread or by charging commissions on the volume of orders. So they don't necessarily make money through your trading. So you need to be clear about that. Like, if the only way they make money is through spreads or by charging a commission on the volume of orders that are being taken or the volume of orders you're making. Okay, so that's it. So that's it. Then we have the B book brokers who have their order books in-house. So A book brokers, their order books are with their liquidity partners. B book brokers, their order books are in-house, meaning that they have control over their orders themselves, and they're the ones who execute those orders. And basically, these B book brokers are also known as market makers. And the challenge with B book brokers is that they tend to take the other side of the client's orders, meaning the broker's profits are often equal to the client's losses. Okay, so they do something called internal hedging. Excuse the typos. I hope you can read that. But so if you understand that, you then know that you most likely prefer to trade with a book broker or an ECN STP broker. Okay. Now, again, the only difference is another difference is ECN STP brokers may give you less leverage. B book brokers may give you higher leverage. Okay, like that's where you get like things like 1:1,000 leverage, and so on. Now, B book disadvantage is they trade against the traders. So that's how they make money. So note the difference. Okay. Now we also have a hybrid model of brokers who actually employ both types of order books. So they have an in-house order book like the big book models, but they also have the A book model. Okay. So actually, this is most of the brokers that I personally trade with are a hybrid model. Okay, they may tell you they're A book, but when you look at it deeper, they are literally hybrid. Okay, which is actually good because it allows them to be competitive with their spreads, whether you're profitable or not. Okay, you see, if they're competitive with their spreads, then it means that you can get really, really good trades. So that's why for me, I like the hybrid model, and because their leverage is good. When it goes to, let's say, STP, as much as they are great as well, sometimes the leverage you get on them is pretty low. Okay, and for me, I just say it like this: if you're going to start trading, especially if you're trading with a small account, you need leverage. Okay, if you're trading with a $50 account or $100 account, you need leverage. But obviously, if you're starting with a high account like $1,000, $10,000, an A book broker would actually be ideal for you because you already have sufficient capital to start trading. But if you don't have, you need the leverage. So hybrid model is good. Stay away from B book brokers, in my opinion. They can entice you and all that with great leverage and things like that, but you can get they trade against you. Okay, so note that. Now, that being said, there are different types of broker platforms. We have three main ones, or let's say the four main ones. We have the MetaTrader 4, or MT4 in short. So if you go to your app store or your iOS or your laptop, you can literally download MT4 or MT5. So the way I like to differentiate between MetaTrader 4 and MT5 is that MT5 is like the Windows 10 version of Windows, and MT4 could be like Windows 7, 8, and so on and so forth. So it's just an upgrade, but it's the same platform. MT5 is just an improvement, has extra features, maybe looks nicer and so on. But MT4 is actually the most, MT4, MT5 are actually the most popularly used platforms by retail traders. Okay, so a lot of traders trade on MT4 and MetaTrader and MT5. Now you can, like I said, you can download the app onto your phone, and you can actually use that to trade from your phone. You can download it onto your laptop and so on. Then we have C Trader. A lot of retail traders don't necessarily use it, or it's not the first platform that they come across. They usually come across it later when they're a bit more advanced, because the versatility between the MetaTrader platform and the C Trader is, obviously, you look at it, it's different. MT4 tends to be a bit much more easier to use, I guess, maybe psychologically even, than C Trader. But C Trader is also a good platform. But the thing with C Trader is, unlike MT4, which is available across majority of brokers across the world, C Trader may not be available with some brokers. Okay, so if you want to use C Trader, you may not be able to use it with some brokers, and you're restricted to specific brokers. Okay, but you can also download the app onto your phone or your laptop and trade. Okay, then we have TradingView. Now, TradingView is a very interesting platform, and I will dedicate a module to just discussing TradingView, but you just need to understand that it's also a charting software. So you can trade on TradingView, and you can also, it's a brilliant, I mean, all these others, you can also look at the charts as well and analyze, and we'll talk about that in future models. But TradingView is really, really versatile, easy to use, beautiful software. But the thing is, it only has a handful of brokers that are linked to it. So even when you go and look at the different brokers that you can trade off of TradingView, they're not many. Okay, that's another disadvantage of TradingView, but it's great for just analysis, which we are going to get into as we go deeper into this YouTube series. Then we have broker web platforms, and these are just the platforms that, your broker, in as much as they give you all these other platforms or opportunities to trade with C Trader, MT4, etc., you can actually trade through their direct platform. Again, this is going to be specific to each broker. Not all brokers, maybe you can trade from their web platforms or even have a web platform. Okay, so it depends. That means that if you're on the internet, you can, or on your laptop and you're on the online, you can go online on their website and trade through their website. They tend to have extra interesting features, but for me, I keep it simple. I stick to platforms like MT4, C Trader, or TradingView. I don't necessarily use the broker platform directly, but you can actually use it, especially if you want to. Okay, so that being said, we have different types of market orders. And what are market orders? We already said an order is, an execution. Either you want to buy or sell. So there are different types of orders that we make as traders in the market. And I put them in, not I put them, but they're in two categories. We have the market execution orders and the limit orders. So market execution, those ones are that's common sense, easy to understand. You literally just place an order, a buy or a sell order. Okay. And when you look at it especially when you look at it on your phone, you may see the app. Once you open MT4 and go to, to trade, you see buy now, sell now buttons, or buy by market, sell by market. Okay. And that is, so I said, if you want to buy now, you just press buy now and you buy, and the order is executed by your broker immediately through their liquidity partners or through their in-house order books, whichever. Then limit orders are now orders that are placed in the future. Okay, so you can place an order, and maybe the reason why you want to place an order in the future is because you've analyzed a chart and you're seeing this this setup or this analysis that I'm doing for this specific currency, whatever it is you're trading, has not yet gotten to a level where you think it's ready for you to jump into the market. So you want to wait, and sometimes waiting, staring at a screen all day may be challenging. So you're going to place executions that can be executed in future, and you're going to use limit orders to do that. So we have these different types of limit orders: buy limit, sell limit, buy stop, sell stop, buy stop limit, sell stop limit. And this is how it looks. So I'm just going to quickly go through this. When we look at a buy limit order, like this one here, okay, basically, this is what we are thinking, that price, this is the level that you want to get into the market. at this level. So we'll look at this more in as we go into the looking at the charts and everything. So a buy limit, you place it when you anticipate that price is going to move down and then it's going to move up. So you're going to place the buy limit order at this level because you want it to, it's going to be coming from up, okay, and then it's going to go up. So let me also say this before even I go further. When you're buying the market, okay, or buying a currency, you're actually anticipating that the price is going to push up. That is why you're buying, okay? When you're selling the market, you're actually going to anticipate that the price is going to push down, okay, or it's going to go down. So that's why you can see the buy limit and buy stop orders are all going up and the sell limit and sell stop orders are all going down. Now we will tackle this more in the technical analysis module as well. So don't worry about that. I just want you guys to know the different types of orders. So buy limit, this is how the price moves. Price goes down and then it goes up. So you buy it as it's moving up. Sell limit is the opposite. Price comes from down going up and then it starts to sell. So you want to sell only after it has made this move up and gotten to this level. That's when you want to sell. Now a buy stop is the opposite of a buy limit here, as you can see. Not really the opposite, but it's slightly different. In the buy limit, it comes from up, then goes up, hits a level, then starts, or how do I say it? How do I explain? Up, down, and then goes up. But a buy stop, you just want to buy at a higher level, okay? So price goes up, and then when it gets to this level, this is where the trade is executed. This is where the buy happens, okay? So again, the difference is very clear, okay? Price in buy limit, it first comes down before you buy, but to the buy stop, you're not even concerned. You just want to buy at a specific level higher than where you started. Same with sell limit and sell stop. You can see the difference now. So sell limit, like I said, price comes from down, gets to a certain level, and then that's when you want to sell. So you actually want the price to go up first before you begin to sell, meaning that you want to sell a bit higher, okay? You don't want to sell at a lower level. So you want the price to first go up, then it's that once it gets to a certain level up where you want it to get to, then sell. Sell stop, price is just coming from up and you're seeing a level where you want to now start selling and you place it. So this is the place, the where you place the order, this is where you place the order, this is where you place the buy limit order, this is how you place the buy stop order. Hope that makes sense, guys. If not, just watch this again or just try and place these orders on your MT4, whether on your laptop or your phone, and see how the market moves or how they're executed in a live market, especially when the market opens, when the market is open, okay? Then we have the buy stop and sell stop limit. Now, you will not see these limit orders categories on an MT4 platform. You will see it on the MT5. So these are just additional. Now, not many people use these orders. Okay, I don't even want to say that not many people, but a lot of beginners may not necessarily want to take a buy stop limit order or sell stop limit order. They may just want to take the buy and sell orders or the market execution orders, or maybe the limit orders and the stop orders, right? So, but on MT5, you'll see this option, buy stop limit, sell stop limit. So what you just need to do, okay, is you're assuming with a buy stop limit, it's the same thing as a buy stop, so price is moving up, but then it also has a limit order in it. So you're not going to buy here, you're going to wait for it to cross this level, okay, then reverse back to the level, and this is where you place your order. This is where it starts buying from, okay? Sell stop is the opposite. We have a key level here that you want to sell at, but you don't want to sell immediately. You want price to first go down and then retest, and then you sell. Okay, so I'm hoping that makes sense. Okay, if it doesn't, just drop a comment. I will try and explain it maybe in a diagram or something like that. So now that we are there, so you may need to now consider opening a demo or live account. Okay, at this point in time, it's very important that you just start practicing to trade on a demo account, especially before you even start with the live account. But it's good to just open a live account so that it's ready for the time when you're ready to go live. Now, usually for a live account, I tell people start with a minimum of $100 if you're a beginner. Okay, if you're a beginner, don't go trying to put $1,000 on your account in your very first trial of trading. Start with a small account. Or let me put it like this. Start with money that you can afford to lose, because like I said in the beginning, disclaimer, the Forex market is a very risky market. You are going to lose money in this market at some point. So in the beginning is not the time when you want to be losing a lot of money. You just want to be learning and and just practicing. So the demo account is for you to practice. It's a simulated account. You can practice and practice on it. So you can open a demo account on your MT4, MT5. You can also open a demo account on TradingView through their paper trading platform. So I'm going to show you that in the TradingView module series. We'll discuss that a bit. But with MT4, MT5, just download the app right now. If you don't have an MT4 or MT5, download it right now from your Google Play Store or your iPhone iStore, or your Apple Play Store, and set up your account. Literally, you can go and open an account. Choose the broker of your choice. I have dropped links of the brokers that I use for MT4, MT5. So you can just click on the links and you go straight to the broker website, set up your account. And then when you're opening the live account, so you have the option to open the demo and the live. When you're opening the live account, please ensure that you have your KYC documents ready for upload. And by KYC, know your customer. Basically, that's what the full acronym reads. This is your ID or your passport, okay? And proof of address. Now, proof of address can be a utility bill of any kind, okay? Here locally, we use our tax document KRA PIN because it has an address, okay? Because in where we are, most people do not receive utility bills. We are a very mobile cash economy, so we actually use our mobile phones, so our mobile utility bills do not have addresses and so on. So we prefer to use a KRA PIN, but if you do have an utility bill, you can use that as well. But literally, you just need any document that has your address, and this address should be the same as the information you filled when you're opening your broker account, okay? So demo is for practicing. You can open a demo account of any amount and practice, lose, make on that account. Live trading account is where now you're going to upload your KYC documents. And then once you are ready and confident to trade on a live account, you start trading. Now, I usually recommend don't start trading live until you have practiced on demo for 3 to 6 months. I know a lot of people may decide, no, they can't wait for 6 months. So minimum 3 months, but 3 to 6 months is ideal for you to practice on demo before you go live, okay? So yeah, and choose a broker of choice. So up next, guys, we're going to be talking about market analysis, and we're going to touch on the types of market analysis. So see you soon.